And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to today's podcast. A lot going on. We're going to talk about what's going on with the Fed. We've never seen such a divided Fed. I'm just going through some of the minutes here, and it's really, this is bad. I mean, they're really, and this is because of the lack of leadership. It's the last thing you want is a split Fed. It doesn't help. The last time we got a split Fed like this, we really felt it. So let's start out with what's happening here with the jibber jabbers that we're seeing every day and listening to every day on financial TV. They are dangerous. Example, today we hear NVIDIA is the single biggest force behind today's rally, climbing 2.3% after Meta announced a long-term partnership to use millions of NVIDIA's chips in its AI data centers. It's like we didn't hear this before. But when you go look at the stock, there's no buying opportunity. What you get are the dopes who come in and buy on dips. They always buy on dips, the dippers. They don't know what they're doing. So let's just take a look at NVIDIA. I'll show you what I mean. You never, and this is the job, remember, this is the job of Wall Street. The TV jibber jabbers. They're supposed to make everything so optimistic, so that everything is flowers and ice cream. So here we are. If you take a look at the chart, look at this consolidation. Okay, but look at this. This is what nobody's talking about. If you go back to October 30th, 2025, what do we have? We have a defined head and shoulders platform. Look, there's your head right there. That's not good. Here's your shoulder here, and here's your other shoulder over here. You got a head and shoulders platform. The volume, you go back to at least the last 10 days, you always want to go back 10 trading days, it's terrible. You got many more sellers than buyers. So today we have this little move to the upside. I think it's 1.5%, I have to check. But you see it right here. Let me bring it back a little bit for you so you can see it. This is ridiculous. So let's bring it back 3 months. Look at this. So it hit a high today, okay, of 190.37. Now it's back to 187.25. The low today, okay, was 186.97. We're at 187.23. We're going to go back to those lows. In fact, this morning, the opening high, okay, she started to rally, and then bam, look, gave it all back, is now making new lows. So be very careful when you hear these headlines. And they do this all the time. That's their job. And this is where people get hurt. You got to follow the money. Talking about the money, follow the money. You got to follow the yields. Yields are everything. 10-year treasury yield is everything. In fact, I'll show you in a minute. If you look on the chart, the 10-year yield, I mean, it just fell off a cliff. It's down 4%. Since February 9th. Now, that's not a catastrophe. It's not something that we're going to get worried about, but it's something you got to pay attention to. Now, when you get all of a sudden, when you get beyond that 4%, then it is a problem, but right now it isn't. And what they're doing, they're coming in, the bond market, they're coming in and they're buying, because they want to keep it above that 4%. They don't want to drop it down below that 4%. Then you'd have a real problem. So again, NVIDIA, here I have it right here now, it climbed 2.3%, but it's not a trade. What are you, nuts? It's not a trade. There's no trade here. So you're going to get all these tourists jumping in, as they did, and they jumped in right at the peak today, right at the high, the FOMOs. They jumped right in at 190.37. Now they're losing money. And look at this. My color-coded chart, it's red. It's telling you there's more money coming out than going in. Be very careful of these headlines. This, NVIDIA did not deserve a headline like this. It only gets traders in trouble. Really, when you hear a headline like that, break it down, look at the yields, find out what's going on. Let's talk about the yields for a moment. So the January Fed minutes, okay, there's never been such division. Again, everybody wants to cut rates, cut rates, cut rates. And every time they talk about cutting rates, the yield will drop. Dollar drops. And what does that help? Let's see. I'm going to go over to my chart, just so you know why they keep fighting to get those yields down. If you look at, for example, if they can push that 10-year yield down, okay, get that 10-year yield down, what rallies? Your technology, your ETF, XLK. What else rallies? XLC, your communication services. What else? XLY, discretionary. What else? Utilities, XLU. And builders, XHB. So it's important to drive those yields down. They want to drive those yields down because Wall Street controls the Fed, and they got money in these specific groups, like tech, XLK. So they want to drive it down, drive it down, drive it down. And that's why they got to split. They got to split a Fed. Now, on the other hand, if you drive yields down, you can short the banks. And we did that. We shorted the big banks. You can short energy. Now, that wasn't a good thing to do because energy's been going up. Why? And that's another thing, too. When these guys on Wall Street, these TV jibber jabbers, tell you something exciting, go buy this stock because of this and that, you better check because it doesn't always work the way it's supposed to work. I know when yields are going down, certain stocks are supposed to go up, right? And sometimes it doesn't happen. It just doesn't happen. So you got to be very careful. Even though we know what stocks will go down when yields are up, when the yields are down, we know what stocks are going to go up, and when the yields are up, we know what stocks are going to go down. But they don't always go that way. You got to watch your the money. Where's it going? And you got to follow that money. Now, the January Fed minutes, okay. It's so bad because you can see what's going on. They're all, they got to get the yield down, keep the market rallying, What rallies the market? Tech. And that's why they always push it. So think about this. What pushes that 10-year yield up, okay, is you got to have strong economic data. We don't have that. And when you have strong economic data, or when it looks hot, as they call it, right? Strong jobs, strong spending, investors expect higher rates, and so the 10-year rises. And again, it's sometimes, as I said, it doesn't always go the way you think it's going to go. So again, take the treasuries. When there's big deficits, sometimes the treasuries won't go in the direction they're supposed to go. Okay? Because again, you remember in treasuries, you have the treasury itself you're paying for, but you have also a risk premium. Now, the risk premium simply means, think of it like the airport. You go, you pay money to get on a plane. There you get your ticket. And then you have to pay another for your baggage. It's the same thing. You're paying another ticket on the deficits. It's like a surcharge. And think of it like baggage. It's just another charge, and if things get risky, you're going to have to pay more. And so, again, things don't always go the way they're supposed to because, one, of deficits. Treasuries have what they call a premium, okay, where it's like a surcharge, and that is the surcharge. That happens when people get nervous, when there's deficits and geopolitical issues. and volatility. So you got to always be careful. Yes, the 10-year Treasury is the best thing in the world. It will tell you which way the market's going to go. It will always tell you which way the market's going to go. And just like with emerging markets are very important, right? We know that. But if the Fed cuts rates, the emerging markets benefits. If the Fed hikes rates, it gets hit. And the 10-year Treasury yield, okay, remember, this is the important one. Remember, the emerging markets are so important, and sometimes people forget about them, but everything, remember, it happens because of the yields. So what you got to look at for the emerging market is if the Fed rate, they cut their rate, then your emerging markets benefit, so you can buy the stock EEM, okay? If the Fed hikes rates, then you can short EEM. If the 10-year yield rises, then you also can short EEM, the emerging market. So everything is dictated by yields. That's why you've got to watch those yields. And even then, the yields can fool you. Start watching, of course, okay, the flow of money, where it's going, all right? It's very, very important. So rate cut expectations, okay, push yields down. And that's what we've been seeing since February. And the yields go down, the dollar goes down, and those stocks that like a weak dollar rallies. I just went over some of them with you. And when the rate cut expectation, they want that. As long as they can keep that word out there. Yeah, I think we're going to cut rates. We expect to cut rates. That's going to push your yields down. And you have a whole slew of stocks that are going to go up. So it always benefits, okay, these yields to go down. That's where everybody makes money, when yields go down. That's where all the benefits are. And so, but sometimes, again, they can trip you up, okay? So again, when rate expectations are pushed one way and everybody thinks, okay, I'm going to go buy these sort of stocks because they're going to do this, sometimes you find out they don't. They don't. But, and sometimes sometimes you're sitting there and the bond market will say, no, okay, we're going to have a weak economy, we're going to have a weak economic data, we're going to have falling inflation, we're going to have rising unemployment. And that's what happens when rate cuts are expected, yields go down, people think immediately, okay, this is good. Why? Because we have weak economic data, falling inflation, we have rising unemployment. We need to cut rates again. So everything is interpreted by, we got to cut those rates because everything's bad. And that's all we've had is since February 9th to today, we've had, or yesterday, until we hit the support at 4%, everything was bad. Everything we had was bad. We had lower wages, we had rate cut expectations, right? We had slower spending, slower economy. And by the way, they keep lying and saying our GDP is going to be 5%. That's a bold-faced lie. It's not 5%. They keep on using the 5% of the third quarter of 2025. They keep going back and dragging that back. That's all they talk about. You have that cut? Well, you can pay that cut. This was yesterday. Listen to what they're saying yesterday about the GDP, which is just crazy.
I mean, I think we just have to step back for half of a minute here and realize that and appreciate that the economy is growing close to 5%. Yeah. And if we didn't have the shutdown in November, we'd be at 7%.
That's a lie. Total lie. GDP is 1 to 2% at best. That they keep picking up that 5% for the third quarter of 2025, and they keep using it over and over. So, and remember, all we've seen is yields dropping because things aren't good. That's what it tells you. Things aren't good. So when the economy's, in spite of what we hear all the time, like this garbage, we're going to go 5, 6, maybe even 7% GDP. So just know this: when things aren't good and the yields start dropping, follow the money before you follow the yield. Make sure. And then again, when you go and you see the yields are coming down, make sure you're in the right groups. For example, you want to make sure when yields are going down, right? When yields drop, you want to be shorting. You want to be shorting XLF, the banks, right? You want to be shorting energy. You want to be shorting industrials. You want to be shorting materials. That's what you want to do. When yields go down, make sure you're shorting those. Okay? And yields go up, make sure you're long the banks. It's pretty simple. Or go long energy. Now, does it always work perfectly? No. But you can protect yourself by just following the money. So our whole world, including the emerging markets, all is surrounded by these yields. And they keep trying to put bad news in to drive them down. But it doesn't always work. For more information, go to philsgang.com. And remember, we have a webinar this Saturday, noon to 3. Check it out.